Hi, and welcome to our next presentation, this time with Addtech. And in the studio, we have Malin Enarsson, CFO, who will present the company. And afterwards, we will follow up with a short Q&A. Myself, my name is Mac Bacco, and I'm an equity research analyst here at ABG. And with that said, Malin, please go ahead with the presentation.
Thank you, Max, and warm welcome to all of you who are looking. I'm going to have a presentation of Addtech. I am Malin Enarsson, and I am the CFO of this group since 3 years. But I've had the pleasure of working in this group for 18 years in total. We are a technical solutions group comprising of 140 strictly decentralized companies operating all under their own brands. Addtech is originated from the conglomerate Bergman & Beving and has been separately listed for 20 years. The group has an annual total turnover of about 13 billion SEK with an operating margin slightly above 12% on an annual basis. It's possible to run this engine of entrepreneurial-driven companies thanks to a clear organizational structure, simple financial targets, and a strong and trustful culture. Our value proposition can be divided into 3 parts: own products and brands, modified products and solutions, and trading products. All with high knowledge of customer needs and clear focus on close relations, also to suppliers. Over the last 10 years, the mix has strategically moved upwards to more value add, and now we have a very good mix with about a third of each, which we believe is a very strategic and good mix. Important, though, to mention is that trading products will always be an important part of our business model. They are often crucial OEM components and gives us a flexibility. Key for us is to have a balanced mix between segments and customers. Keep the hedge we have in the segment spread. Our aim is to continue being a resilient company, not being too dependent on any single segment or customer or market. Our sales is divided approximately 50% to OEM, 25% infrastructure, and 25% aftermarket. Our largest segment is the energy sector. Wind power and transmission, very good steam ahead right now, while oil and gas is a quite small part today. Transportation, this is where we have the marine segment. Basically, the only segment where we still see low activities due to COVID. Mechanical industry and special vehicles. Here we have a lot of OEM components and solutions. Here we have seen a clear growth this year. Even though we have easy comps here, it's still a strong underlying market demand. Forestry has had very good development. Many projects ongoing in sawmill industry, and process in general has also had stable development. Medical technology, good development, and our other segments like road tunnels, defense, and agriculture have had stable development. Very briefly about the 9 months that have passed on this fiscal year. We have had very high demand and activity in all our business areas. Net sales up almost 24%, of which 13% was organic growth. Of course, we have had challenging situation with supply chain constraints and global shortages of several components. But through the strong entrepreneurial spirits among our employees and the upside of running this business as a decentralized organization, our companies have managed the situation in a very impressive way. Despite a certain increase in costs, EBITDA increased by 51% with strengthened margins in all of our business areas. The cash flow generation remains stable, primarily thanks to our increasing profit. Although it's partly offset by increasing receivables due to increased volumes and then also inventory buildup. We need this to fulfill customer demands and to handle longer lead times. All in all, we are very satisfied to see that our R through RK reached the top level last quarter at 66%. What are we aiming for in the future? Last year, during 2021, we launched an updated vision. It's not a new direction. It's primarily 2 things we wanted to highlight. Focus on sustainability as a driver for future growth. and also the shift towards solutions rather than components. This vision works also as an inspiration for all employees and attracts new entrepreneurs and talents. We have a clear strategy that is unchanged for the last decade. We're aiming for market-leading positions and are therefore active on small niche markets with low or medium volumes. We believe that being leaders in a specific niche is a way to be differentiated and to generate long-term profitable growth. Acquisitions. We only buy profitable companies. We like to buy companies that we deeply understand and therefore can develop. Operating mobility. We have an eternity view of our ownership, but we are a very active owner even though we don't sell companies. Even though we have our high degree of decentralized responsibility, we work closely together with our companies to find the best way forward. We invest in organic growth in relevant business cases, and we gradually develop our companies to ensure future growth. We only have 2 simple and easy to understand financial targets that are the same throughout the whole organization. Firstly, in average, the earnings should grow with at least 15% yearly over a business cycle. The growth should be divided equally between acquisitions and organic growth. The ambitious growth target means in practice that we should double our profit every 5th year. Profitability is of course also key, not least from a cash flow perspective. To be able to continue to acquire at a high pace, we target an R/RK above 45% in all of our entities. When we sum up the last 20 years, we can see that we have had a compounded average growth on EBITDA with 18%. A clear proof of the resilience and strength of this business model. Also, from a profitability perspective, we are way above our ambitious target. The last 2 quarters are historically high, but key here is that we have over time delivered at very satisfying levels. Sustainability is highly integrated in our business setup and has been part of our DNA for many years. To make our ambition more visible, we have set targets in line with the Paris Agreement. All our companies are fully committed and work in a structured way to reach our goals. What is most important is that we see sustainability as core in our growth story. By working closely with the customers to identify the best and most sustainable solutions, we can be a catalyst towards a more sustainable society. Our corporate culture, the spine or the DNA of our organization, it's all about how we interact with each other, the way we work together as a team, taking responsibility at all points and always with the customer in focus in an entrepreneurial way. In management team, always, of course, also keep our central organization as slim as possible, keep the reporting as minimal as possible, so that our companies can focus on their business. And of course, being open for change. This is what makes Addtech unique and attractive to potential new companies and employees. It is in our 140 independent companies operating under their own brands that everything happens. Addtech as such is only to be seen as a catalyst for growth. It should be easy to be an entrepreneur within Addtech. Depending on what they need, we are here to support them. Powered by Addtech, we are using the network, sharing good examples and best practice. We talk a lot internally about co-creation, and we have many companies cooperating in both sales and production. We have our business school, the Addtech Academy. 500 employees are attending different courses there every year. We have an introduction course for every employee in our basic philosophy. Also, a very important tool to find internal talents and future leaders. Since 1st of October 2021, these are our 5 verticals or business areas. All with clearly defined niche strategies and key growth drivers to capture and leverage from. The model has been the same since 2008, but we constantly evaluate the clustering to safeguard the entrepreneurial spirit and that we enhance co-creation between the companies. All leaders have either sold or been an MD in one of the subsidiaries. To be able to build from below over time is part of the magic and also an USP when we meet potential acquisitions. They feel that we are one of them. Our model, where we build our pipeline from below, is well proven and has a solid track record of successful acquisitions. We have done more than 100 acquisitions since 2010, and that is without any capital injections. It is notable that the last years, the size of the companies has increased somewhat. We have a constant inflow of interesting companies in our pipeline. We are very careful when selecting companies to acquire, performance and culture being the most important parts of our evaluation. In recent years, we have increased our sales outside the Nordics, both organically through export and following existing customers to new markets, but also through acquisitions, of course. The reason why we see here a downturn in 2021 is, of course, that markets outside of the Nordic region were hit harder by COVID. We have accelerated our activities in selected markets, and we see that the deal inflow is increasing. There are not so many professional investors with long-term ownership outside of Sweden, so there is a big potential. A short summary of our investment case. Why should you invest in Addtech? We have a long-term proven capability of delivering profitable and sustainable growth with a strong balance sheet and a good hedge among market segments. Our strong culture with entrepreneurial mindset and a very high degree of decentralized responsibility are our real key success factors. Thank you, and questions?
Yes, thank you very much, Malin, for the presentation. And as you said, time for questions. And the first one, what is your current assessment at Addtech of the impact from the ongoing invasion of Ukraine and the sanctions being implemented on Russia in terms of supply chain, raw material prices, and so on, and how it will affect Addtech?
I think first, if we answer our direct impact, so to speak, we are very marginally actually impacted by the situation, even though, of course, that is just sort of a fact. I mean, emotionally, I think we're all very affected, of course, and discussing all the time and try to predict what will happen. Yeah. But we have close to I would say zero sort of suppliers in Russia. We have marginally exposure to sales in Russia. But of course, indirectly, it could be other consequences if this accelerates or if sanctions are increasing or such. But as such, we are quite marginally affected. I mean, as a fact, not emotionally.
And as you mentioned during the presentation, a common theme during the last quarter or year has been strained supply chains and cost inflation, which has been affecting Addtech and other companies as well, although we have been able to offset a lot of the cost inflation with price increases. But in this quarter, in the beginning of 2022, have you seen any improvements in these areas, or is it still an ongoing issue?
I would say that what we have seen so far, it's more or less the same. No real ease, but it's not getting worse either in that area, I wouldn't say. So I think that our companies, they have been great in actually compensating for price increases from increased prices from suppliers. And they have also been very good at sort of getting their products. So they have been doing a great job so far, and still we feel that it's quite the same. And you also mentioned during the presentation that there has been some inventory build-up during the past
3 quarters. Do you expect a cash release in 2022 due to inventory levels normalizing, or is it further ahead?
I think that this will probably go on for quite some time.
Yeah.
I mean, if the supply chain restraints will ease up, we might see a bit of a capital release from inventories. Even though, I mean, it is a known fact that when we have growth, we also have a bit of a restrained cash flow. So, but I think that probably it would, if we have increased volumes due to more sales, due to the fact that we get products and can actually sell them, then it will probably be offset partly by increased receivables, but maybe a bit of a release.
Okay.
It's not that bad yet with the inventories, but we can see that it's happening slowly, and it will probably continue for quite some time if there's no release in sight.
And as you mentioned, the R over RK was a record high 66% in the...
It was, yes, it was.
And as you mentioned also in the presentation, for the last quarters, you have seen a very high level of customer activity and a good demand, resulting in strong organic growth. Have this continued in the ongoing quarter, and what end segments are performing the strongest at the moment? You did mention that somewhat in the presentation, but do you see that the underlying demand is still there?
Really, yes. I think that we see still very good underlying demand, and also good pace in sales. So, and I would say, as I think I mentioned also, that all of our segments have had sort of good pace this year, maybe then except for the marine segment. So it's still the same. Of course, sawmill industry, very strong. Energy segment, very strong demand, of course, with the building of grids and such. So, but all in all, I would say that all of our main market segments have had good development this year.
And in the last quarterly report, you guided for slightly higher costs associated with sales promotion activities going ahead, or one could say a normalization of those to pre-pandemic levels. Sort of. Have you begun to see this, or do you expect it to come later in the year?
I think that we saw some of it already in Q3, because as we predicted, we had the highest boost in Q1, Q2 when it comes to EBITDA margins due to savings last year. So we can see that it is increasing costs, but I don't believe it will be back to pre-pandemic levels, actually.
Okay.
So I think it will increase, but not to that level, because we have made certain efficiency measures, and I think that we will work in a bit of a different way, also when it comes to travels and digital meetings and such, continuously. So a slow sort of normalization, but on a sort of lower level than before, is my prediction.
Okay, and finally, and the usual question, how does the acquisition pipeline look like going ahead?
It looks very good, actually. Yes,
sure.
as always, yes. A lot of, I mean, since our acquisitions are generated from our organization, from below, if you say like that, and they have their networks, and their sort of our companies, they have their network, so it's always a very good inflow. And then, of course, we do strict evaluations from different angles, but the pipeline is very good.
Do you find it more difficult to approach potential sellers outside the Nordics, which are not perhaps familiar with this decentralized model that you are running?
Maybe not more difficult, but it is, of course, a fact that our very decentralized structures, very non-hierarchic, is new to certain cultures. And there we have to spend a lot of time trying to explain that it's actually true, that this exists in reality. And therefore, of course, it's very good with this network, because if we like to sort of dig where we stand and expand from and not go for blank spots, and that is of course an advantage if we have a company already in the group talking to another company. They can sort of confirm that this is the way that it's actually is done. So that is also an advantage with generating acquisitions the way we do, I believe, at least.
I think that was all the questions I had. Thank you very much for joining us here today. Very nice to hear about Addtech. And I guess we'll see you soon again.
Hope so.
Thank you.
Thank you.